The airline industry is a complex and competitive market that operates on a global scale. The economics of airlines are influenced by a variety of factors, including the cost of fuel, labor, and aircraft maintenance, as well as the demand for air travel and competition from other airlines. One of the biggest expenses for airlines is fuel, which can fluctuate greatly in price. In addition to fuel costs, airlines also have to pay for maintenance and upkeep of their aircraft, which can be expensive. Labor costs are another significant expense for airlines, as they must pay for pilots, flight attendants, and other staff. The demand for air travel can also greatly impact the economics of airlines. When demand is high, airlines can charge higher prices for tickets and make more profit. However, when demand is low, airlines may have to lower prices to attract customers, which can impact their profitability. Competition is also a significant factor in the airline industry. Airlines must compete with each other to attract customers and offer competitive prices. This can lead to price wars and lower profits for airlines. To remain competitive, airlines must constantly adapt and innovate. They may introduce new services or amenities to attract customers, or invest in new technology to improve their operations and reduce costs. Demand and cost. In airline economics, demand and cost are two key factors that determine the profitability of an airline. Demand refers to the number of passengers or cargo that are willing to pay for air travel on a particular route or at a particular time. The demand for air travel is affected by factors such as the economy, travel trends, competition, and seasonality. When demand is high, airlines can charge higher prices for tickets and increase their revenues. Conversely, when demand is low, airlines may need to lower their prices to attract customers. Costs, on the other hand, refer to the expenses that an airline incurs to operate its flights. These costs include fuel, labor, maintenance, airport fees, and other operating expenses. Airlines need to carefully manage their costs to remain profitable, particularly in a highly competitive market. By reducing costs, airlines can offer lower prices to customers while maintaining their profit margins. In airline economics, the relationship between demand and cost is critical. Airlines need to balance the demand for air travel with the cost of providing that service. If the cost of operating a flight exceeds the revenue generated from ticket sales, the airline will incur a loss. Conversely, if the airline can generate enough revenue to cover its costs and make a profit, it can remain financially viable. To manage demand and costs, airlines use a range of strategies, including pricing strategies, route optimization, and fleet management. By analyzing data on passenger demand, market trends, and costs, airlines can make informed decisions about pricing, scheduling, and other operational factors to maximize their profitability. Airline ticket pricing. Airline pricing is a complex and dynamic process that involves many factors, including supply and demand, competition, fuel prices, seasonal changes, and various other operational costs. Airlines use sophisticated computer algorithms to determine the optimal prices for their tickets. These algorithms take into account various factors such as historical pricing data, current demand for a particular flight, the number of seats available, and the overall profitability of the airline. The pricing for airline tickets can also vary depending on the time of day, day of the week, and time of year. For example, flights that depart early in the morning or late at night may be less expensive than those that depart during peak travel times. Similarly, flights that depart on weekdays may be less expensive than those that depart on weekends. Airlines also use various pricing strategies, such as yield management, to maximize their revenue. Yield management involves adjusting ticket prices based on demand in order to ensure that planes are as full as possible while still generating the highest possible revenue. Airline market segmentation. Airline markets refer to the various segments of the air transportation industry, including domestic, regional, and international flights. These markets can be broken down further based on factors such as passenger demographics, travel purposes, and pricing. One way to categorize airline markets is by geographic region. For example, the North American airline market includes airlines operating in Canada, the United States, and Mexico, while the European airline market includes airlines operating in the European Union and other European countries. Another way to categorize airline markets is by passenger type. For example, Leisure travelers typically look for affordable flights and may not be as concerned about flight schedules, while business travelers often prioritize convenience and schedule flexibility over price. Airline markets can also be segmented by the type of service offered, such as economy class, premium economy, business class, and first class. Airlines may cater to different markets by offering a range of services and pricing options. Understanding airline markets is essential for airlines to create successful marketing strategies, pricing strategies, and route planning. Airlines need to identify their target markets and tailor their services and pricing to meet the needs and preferences of those markets. Airline competition and consolidation. Airline competition and consolidation are two major forces that shape the airline industry. Airline competition refers to the level of rivalry among airlines for customers, routes, and market share. Consolidation, on the other hand, refers to the process of airlines merging or acquiring other airlines to increase their market share and reduce competition. Competition in the airline industry can be intense, with airlines competing on price, service quality, routes, and other factors to attract customers. This can lead to lower prices and better services for consumers. However, intense competition can also lead to lower profitability for airlines, which can make it difficult for them to invest in new aircraft, technologies, and other improvements.